Welcome to the Q2 and H1 FY25 earnings conference call of Happy Forgings Limited. These conference calls may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference call is being recorded. I now hand the conference over to Mr. Ashish Garg, Managing Director from Happy Forgings Limited. Thank you, and over to you, sir.
Yes, hi. Am I audible?
Yes, sir. Please go ahead.
Good morning and a very warm welcome to all of you to Happy Forgings Limited Q2 FY25 earnings call. With me, I have Mr. Pankaj Kumar Goyal, our CFO, and Strategic Growth Advisors, our Investor Relation Advisors. I trust everyone has had the chance to review our financial statements and investor presentation for Q2 and H1 FY25, which we have filed with the exchanges. Let me start by outlining the highlights of our financial and operational performance this period. In Q2 FY25, we achieved growth in both absolute revenue and profit numbers as well as profit margins despite challenging conditions in underlying industrial segments. We saw steady broad-based improvements with revenue, gross profit, EBITDA and PAT all showing year-on-year and sequential gains. For Q2 FY25, revenues reached 361 crores with EBITDA at rupees 105 crores and PAT at 71 crores, marking a year-on-year increase of 6.1% in revenue, 13.6% in gross profit, 14.8% in EBITDA, and robust 23.8% growth in PAT on adjusted basis. We continue to deliver industry-leading profit margins, and our gross margin and EBITDA margin for the Q2 FY25 surpassed 58% and 29% levels respectively. The gross margin expansion for the quarter resulted from increased value addition with our product offerings, complemented by the favorable impact of declining steel prices. Our realization trends continue to improve steadily due to enhanced value addition, with Q2 FY25 realizations at ₹253 per kg, up by 3.6% year-on-year on adjusted basis. For H1 FY25, realizations stood at ₹249 per kg, growing by 3.7% on adjusted basis despite a decline in steel prices. Finished goods volume remains steady with Q2 FY25 and H1 FY25 volumes up 2.4% and 2.6% year-on-year respectively. Let me now walk you through some key segmental highlights. Our machining mix improved further sequentially to 89% in Q2 FY25 and stands at 88% as of H1 FY25. Our endeavor going forward would be to increase the portion of machine components to a relatively higher value addition content to improve our realizations and margins further. We have proactively pursued revenue diversification across industries and geographies, increased our share of new businesses, and expanded our wallet share with existing customers. This strategy has improved our resilience against market cyclicality and downturns, enabling us to achieve growth that outpaces the broader industry. Our segmental performance this period reflects the success of this approach as most underlying product segments, both domestic as well as exports, including steel prices, face degrowth. International and European CV, farm and off-highway industrial segments are facing significant degrowth. Despite this, we are able to grow our direct export business by 5% year-on-year in Q2 FY25. As a result, the share of direct exports in total revenues has remained more or less stable at 19% year-on-year on adjusted basis. The passenger vehicle business segment continues to perform strongly, steadily increase its contribution to overall sales, and now contributes to almost 4% of the total revenue mix. With deliveries of North American EV segment products scheduled to begin in second half of FY25, the segment's share in the revenue mix is anticipated to rise even further. Domestic and European markets are experiencing a challenging year. The major European CV OEMs are projecting a 12 to 15% decline in CV sales for calendar year 24. Domestic truck production is down by 7% year-on-year in H1 and fell by 13% in Q2 in FY25. Against this backdrop, our CV segment has outperformed the underlying market, achieved a modest year-on-year growth of 2% in the first half of FY25. In H1 FY25, domestic tractor production volume showed a marginal increase of 2% year-on-year. The European agricultural market segment continues to remain challenging, with leading OEMs expecting a degrowth of 15 to 20% in unit sales for calendar year 2024. We were able to manage a better than industry growth in farm equipment segment in H1, especially in Q2 25, where both revenues and volumes increased by more than 10%. In the off-highway segments and industrial segments, domestic market for mining and construction equipment is estimated to witness a decline of 67% in unit sales in FY25 due to general elections, slower project awards during the year, and tightening of financial environment. On the other hand, sales of construction equipment in Europe are expected to witness a decline of 15 to 25%. Consequently, our sales in off-highway segments witnessed a mid-single-digit decline in H1, but industrial segment showed a mid-teen growth year-on-year on adjusted basis. While underlying segment conditions impact our business, our continued focus on diversification has played out and insulated us from downturn in export and domestic market segments. Our new product development and new business segments have supported our growth during this phase. As a result, we have been able to grow better than the underlying market, and when the tide turns, we are hopeful that we will be able to register outside growth as our share of business remains intact and we continue to build pipeline of new business wins. Our installed machining capacity at the end of H1 FY25 now stands at 57,000 metric tons, and production on newly installed press of 6,300 tons also commenced during the quarter, thus expanding our forging capacity to 127,000 metric tons. We will be further adding machining capacity in H2 2025 as well, and we expect production ramp up on these lines, enabling us to execute and create capacity for growth. While market conditions will continue to be dynamic, our steadfast focus on maintaining a strong balance sheet and focusing on high quality and value accretive products, businesses, medium-term macro growth enablers for the business remain positive, and we believe that investments in world-class infrastructure will enable us to scale up organically, ensuring appropriate returns on investment. Now I would like to hand over the call to Mr. Pankaj Goyal for an overview of the financial performance during the quarter. Thank you.
Good morning, everyone. Myself, Pankaj Goyal. I hope I'm audible to all of you.
Your voice is audible. Please go ahead.
Thank you. I would like to take you through in brief on financial results of Q2 FY25 and H1 FY25. As mentioned in the previous quarter, our financials in Q1 and Q2 FY24 were favorably impacted by some higher license received on one order on account of logistic costs. This positive impact for H1 FY24 was to the tune of 13 crore in revenue, 9 crore in EBITDA, and 7 crore in PAT. Furthermore, we also recovered a non-recurring income of 6.440 crore in Q2 FY25 on account of maturity purchase on one insurance policy, impacting PBT by 6.4 crore and PAT by 4.8 crore. To facilitate a fair YOY comparison, we have additionally provided adjusted margin growth and revenue share numbers after adjusting for these impacts in H1 24 and Q2 FY25. Revenue for the quarter stood at 361 crore for Q2 FY25 and rupees 703 crore for H1 25. These represent a YOY growth of 6.1% and 6.4% for Q2 and H1 respectively on an adjusted basis. Despite declining in steel prices, which had an impact on our revenue growth, our relations improved by approximately 3.5% YOY for both Q2 and H1 FY25 on an adjusted basis. Finished goods volume increased by 2.6% YOY for H1 FY25 and 2.4% YOY for Q2 FY25. Our EBITDA margin inched closer to 29% and stood at 29.2% for Q2 FY25 and 28.9% for H1 FY25, growing at 14.8% and 9% for Q2 and H1 respectively on an adjusted basis. PAT grew to rupees 67 crores for Q2 and stood at rupees 130 crores for H1 on an adjusted basis, showcasing a Y growth of 23.8% for Q2 and 15.8% growth for H1. Our balance sheet continues to remain robust. Total net worth stands at 1,700 crore approximately, and our debt equity ratio as on September 30th continues to be lower than 0.1x. We hold a cash liquidity of approximately 250 crore as on this quarter end, including which is 156 crore of long-term fixed deposits reflected in our non-current assets in the balance sheet, and remain positive about our cash accrual capabilities that position us strongly to capitalize on any organic or inorganic growth opportunities in future. ROCE was 20.6% and ROE stood at 16.3% for H1 FY25. And we expect these return ratios to improve as we deploy the capital raised last year and improve utilization rates. That is all from my end. I now invite Mr. Sridhar for closing remarks. Thank you.
Thank you, Pankaj. Our continuous endeavor would be to navigate industry-wide challenging times while increasing our market share in the new businesses. We are all geared up. Our robust engineering and machining capabilities, coupled with the advanced technologies we employ in our manufacturing operations, which position us well to capitalize on the market opportunities. With this, I would like to thank everyone for joining on the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with me or Strategic Growth Advisors, our investor relation advisors. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question is from the line of Pankaj Tibrewal from Ikigai Asset Management. Please go ahead.
Good morning and thank you for the opportunity. First of all, congratulations on great margin improvement. And there are very few B2B companies in India which can do cross margins in excess of 50%.
Sorry to interrupt, Mr. Pankaj. Your voice is not audible.
Can you hear me now?
Yes,
can you hear me
please
now?
go ahead. Yeah.
Yeah. So, no, thank you for the opportunity and congratulations on good margin improvement. Ashish, what I wanted to understand from you is that from a 2-3 year perspective, what are the growth levers the company is evaluating which can give them higher growth rates from a 3-year perspective, both from auto side and industrial side? If you can talk us through, it will be great. And congratulations on margins, because very few companies in India on a B2B basis can show margins of gross margins above 50%. So hopefully we expect that should sustain going forward. But from a growth side, if you can talk us through what are the growth levers the company is evaluating from a 3-year perspective. Thank you.
Thank you, Mr. Pankaj. So if you look from the perspective of the current crankshaft business, which is almost more than 50% of the business, we witnessed a growth of almost 14% in quarter 2 and almost 11% in H1. Whereas the legacy forged business, which largely caters to off-highway segment, has seen a degrowth. So going forward, we feel that crankshaft as a product which goes to various segments in industrial, passenger car, off-highway will continue to grow for us. We have entered into businesses for industrial segments, both for portable gensets as well as higher horsepower, which will form a major part of growth going forward for us. Wind sector business is a new business for us, which company started 2 years back. We expect it to be 8 to 10% of company's revenues going forward in next 2 years. We have witnessed a good growth in that segment as well. Largely components are heavy. We expect to be a good part of business going forward. Pascar is as a new sector which was started last year has contributed meaningfully, which is around 4% this year in H1. We expect it to be 8 to 10% going forward in 26-27. We have already won orders from North American market. We are already in touch with these customers for new RFQs and businesses which we have quoted. Even in the domestic side, we are working on certain PV products. So within Forgings, this is the business that we are already doing. We also project to enter into the ring rolling business. That is the ring forging, which we are not doing as of now. We already have plans and ordered certain capacities, which will be additional component with which we can cater to the bearing industry as well. As well as the company also has plans to expand its product as well as the weight range. So currently, we are catering up to 250 kg. Going forward, we also have plans to enhance this product weight range from 250 kg to a 1 ton category size. So this is, I hope I am able to answer your question.
Great. And on the export side, any thoughts on key client wins, key penetration in markets where we are absent now? And how big this export revenue could be for us as you move ahead? And second, on the machining side, you are at 89% already. How much more you can grow from here in terms of value addition so that the margins which you are seeing can have an upside? Or do you think margins at 28-29% can be maxed out? Just some thoughts on both the sides. Thank you.
So as of now, we are not restricting ourselves only to machining business. If we see opportunity to grow in as forge business, we'll be more than happy to do that. But the businesses that we have in hand, most of the businesses are for machined components. We expect that this range of 89-90% will continue. In fact, we can see a higher rate as well because most of the businesses currently that we have are for machined components. Within machining, the more complex components that we are doing now and the investments that we have done are going for the BS6 range of vehicles and also the Euro 6 emissions. So which is in fact a better contribution. If you look at the realization, despite of the falling steel price, the gross contribution has improved by 5 rupees a kg on an average basis. That means the newer businesses that company has captured has come up with better realization. So this will definitely be there. This will be a part of our strategy to continue to grow ourselves in a niche business segment. And exports, as we said that today, 20% is direct exports, 9% is deemed exports. Next 2 to 3 years, we expect this growth, the exports to be in the range of 30 to 35%, because most of the order wins, if you see, 60 to 70% are from global players.
That's great. That's great. Thank you and wish you all the best. I hope you keep on growing year on year over the next few years. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 at this time. Our next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Yeah, hi Ashish. Congrats on a good set of numbers. Quickly wanted to check, one of your customers, American Axle India, has been taken over by your competitor. So can you talk about what kind of revenues do we get from them and how do you see that business shaping up? I'm presuming that that business will go away gradually, but what is our exposure to American Axle in India?
So American Axle India business is for us to the tune of around 45-50 crores. And yes, it has been taken over by one of the peers. But we feel that the main strategy of buying out for the peer is to expand the global footprint in the axle business, as they already own another axle company in India, which is Axle. So from the strategy perspective, we have a very wide range of product range that caters to American Axles in the domestic sector, which is almost 20-25 components, that too which are approved by OEMs in the last couple of years. So we expect that business to continue, and it's a competitive business which is going on from 2011-12.
Okay.
Business of American Axles that we have won and which we are doing directly is going to stay as it is, and it is going to grow as it is. So because it's not, it's in a separate entity.
Right. Got it. And secondly,
From the existing American Axles team is that we can also see this business growing, because the business was not growing too much, for the last couple of years, as was kind of stagnant. So we can see a big growth coming in that business as well.
Right. Got it. And secondly, with respect to our industrial segment, where opportunities are quite few for us, quite many for us, and some of the orders are in hand. So can you talk about roadmap for how industrial segment will shape up over the next 2 to 3 years based on orders in hand? How will the contribution of industrial segment move over the next 3 years? That will be my second question.
So largely the industrial business today contributes around 12-13% to the revenues, which we expect will continue to grow. We expect this business to be in a range of 18-20% going forward in next 2 to 3 years. And largely sectors like wind gearboxes, where we are already ramping up the genset business, and portable and high horsepower range of gensets are the main streams. Besides this, we are also working on certain programs for heavy axles, which are used for material handling systems. So the industrial business could be in the range of 18-20% next 2 to 3 years for sure, the way the new businesses are pouring in this sector.
Got it. And particularly the crankshaft for genset, when are we expected to commercialize that part of the business?
Dinesh, we have already started that, but there are more customers also which we have gained on the portable genset side, and also the high horsepower range. So there's a complete range, and it's in a phase that we should be starting ramping up for the other customers as well from Q4 and next year H2.
Got it. And lastly, with respect to 14,000 ton press, so can you talk about what is our utilization of that press currently, and do we expect by when do we expect that press to be to reach optimum utilization of 80-85%?
So currently the utilization is around 50-55% on the line, and effectively we can touch 80%. So we have around 30-35% capacities available on this line, where we are growing our wind segment business, which we expect to grow in the coming year. Also the front axle beams which are launched for CV players, we have received approval for those, which we will be ramping up from Q4 onwards. So with the forging of front axle beams and the wind sector business, we expect to touch around 70% in the coming financial year, in the next financial year.
Okay. So in that context, our realization as well as gross margins logically should further improve. If I put everything in perspective, 14,000 ton press ramp up happening, industrial business and exports going up. So logically, would it be fair to say there is headroom for margin expansion and realization expansion?
We also have front axle business planned on the line. So front axle business will not be in a similar realization base as our crankshaft business, but we have a couple of crankshaft lines and the machining capacity coming in the Q3 and the Q4 as well. So with the utilization of the crankshaft capacities going forward, we expect, yes, the gross margins would improve. So if you look at our the crankshaft business, we have already grown by almost 14% in Q2 and 11% in H1. and we expect this business to grow going forward as well. This is kind of driving the entire contribution.
Got it. Got it. And sorry, just some clarification on the realization for the quarter. We have seen improvement despite pass-through of steel prices. So any quantum, any number which you can share about what percentage was the impact of steel price pass-through?
So RM impact is to the tune of 18 to 20 crores in H1, Dinesh. I hope I'm able to answer your question.
18 to 20 crore in first half. Great. Thanks, Ashish, and all the best.
Thank you. Thank you, Dinesh.
Thank you. Before we take our next question, we would like to remind participants that you may press star and one to ask a question. Our next question is from the line of Amber Shukla from Motilal Oswal. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. So my first question is related to demand and growth. So our key segment CV, which now contributes around 39-40% of revenue, is seeing some slowdown. And of course, the recovery doesn't seem at par with the expectations. So how do you see this going forward? Because crankshaft CV is also has also high margin for us. So in that way.
So yes, hi Amber. So Amber, if you look at, yes, you are right that the domestic CV, MHCV space has seen a decline of almost 8-10%, whereas this decline is over and above the FY23 numbers, and European CV is also seeing a decline of 12-15%, which at the moment we are not seeing is expected to improve. But yes, we are kind of maintaining our share in the CV business. Despite of this, it has grown by almost 2%, and we have also started doing things which were kind of in a ramp-up phase. We have received approvals, and we have started ramping up in the third quarter for the domestic CV clients. So we expect to maintain good growth even in the CV business going forward. We are not losing on the CV volumes.
Okay. And my second question is on industrial. So, like in other segments, we have, especially for exports, we have seen delays in different categories at global level. So, what is the status for industrial categories? So, just some clarity on demand scenario in different industrial segments where we are operating right now.
This is the degrowth as but even if you look at the industrial segment. But as most of the projects are new for us, we are able to grow in the segments, and going forward, because it's a continuity of the business which was started 1.5 years back. So we still have a chance to improve and ramp up on the share of business. The share of business is improving, even though the total market size has reduced over there. So wind sector will be further growing for us.
Okay, so since we have orders in our hand for industrial category, as of now, are we seeing any kind of delays in execution or something? I mean, from the client side?
Yes, there are certain delays, but the approval processes have been completed. So they also have a lot of cost pressure, if you see globally, because of the slowdown, which can actually trigger the businesses from India. That is what I feel.
Okay, sir. Thank you. That's it for me, sir.
Thank you. Our next question is from the line of Sonal Gupta from HSBC Mutual Fund. Please go ahead.
Yeah, hi. Good morning, and thanks for taking my question. Ashish, earlier you'd mentioned that there was some constraint on machining capacity, and there was a delay in receiving the machines, and we were going to see a ramp up in Q2, Q3. So just wanted to check, is all that capacity addition happening on track? And really, with that coming on stream, and also I think the 10,010-ton press will come on stream, how are you looking at ramp up in the next few quarters? Or is it going to be mainly driven by the underlying industry performances? How do you see the overall environment in the near term?
Thanks, Sunil. So Sonal, if you look at it, the machining capacity has increased to 57,000 tons in by end of H1 from 50,000, which further we expect that we'll be touching close to 62,000 tons in H2, and the process is ongoing. And that is the reason the crankshaft business has grown by almost 14% in quarter 2 and 11% in H1. We expect this business to grow positively in third quarter as well as fourth quarter as the new lines are coming up and the ramp up is happening. But yes, because of the industry slowdown, the ramp up is also impacted. But we are ramping up for these customers. PV business has picked up. The domestic CV players for which the testing has been completed, we are ramping up. So that's all on track, and the capacities have also planned well for the third and the fourth quarter. So yes, we have witnessed a sharp decline in our legacy forged business, where the contribution is less, but yes, that has been affected because of the off-highway programs in European region. But as far as capacity is concerned, 6,300 ton line, which is planned for the PV segment, is already installed and up and live. So the PV business that we expect to start from fourth quarter is also on track. And also the 10,000 ton line is almost ready in Europe right now, so which will be coming in next financial year. So in terms of capacity, yes, the way we have planned, it is on track. In fact, there are certain more capacity additions which will be announcing very soon, which are in discussions in another 1 month time. So which we are in discussion with our customers, which will be from a different product profile.
Got it. And in terms of right, so this is so 6,300 ton line would be dedicated for PV components, right? That's how
majorly for PV and the portable genset products.
Okay, because I thought we were also looking at some 4,000 ton press for portable genset.
Yes. No, that is again for PV. That's kind of again those are for like PV small parts, which is coming in next year.
Got it. But I mean, like these capacity ordering is sort of backed by orders, is how we should understand it. To a fair degree, obviously you cannot have like, but I'm just trying to understand like how much is of this ordering is in anticipation versus really, I mean, like you have some line of sight on some of these utilization of some of these capacities.
The 6,300 ton line is kind of, will get fully utilized by next year because it's part of the PV business, and PV business is kind of picking up. It's like 4% this year. And we also have the genset business going on with this line. 4,000 ton line investment is kind of a dedicated investment for one of the customers, which is where the capacity is fully committed by that customer. That's an American customer for PV.
Got it. And just lastly, anything in terms of like we were earlier also planning to invest in Jammu for machining capacity. Is that plan on track? How does that shape? I mean, what's the timeline there?
The capex on Jammu, we have already filed 2 proposals with the Jammu government, and decision is kind of awaited with a tune of 100 crores and 60 crores. So if we have approval in hand, we can go ahead. So far, we have not done investment, but we have gone ahead with forming a subsidiary and applying for it. Because of election, there is some delay. If we have clarity over it, we will be going ahead for it.
Got it. Great. Thanks, Ashish. Thanks for taking my questions.
Thank you. A reminder to the participants that you may press star and 1 to ask a question. Our next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Girik is taking us there. Huh?
Hello, Mr. Dhaval. Hello.
It's like this.
Our next question is from the line of Kush Nahar from Electrum Portfolio Managers. Please go ahead. Mr. Kush? Hello?
Hello, am I audible now?
Yes, please go ahead.
Yeah. Thank you for the opportunity, sir. So, considering the growth drivers that you mentioned previously, what kind of top-line growth are we seeing for the next 3 to 5 years? And is it safe to assume that these 29% EBITDA margins are sustainable and growing upwards?
Sorry, can you come once again?
So my question is that considering the growth drivers, like you previously mentioned, what kind of top-line growth are we looking at for the next 3 to 5 years? And is it safe to assume that these 29% EBITDA margins are sustainable and going upwards, going ahead?
Okay. So, I'll just give you, the brief on all the industries and how we plan it. Definitely in terms of margins, we expect to maintain our margins in a similar range because in a range of say 27 to 29%. And at the moment we are not giving any guidance upwards of 29%, but the gross contribution level is a major factor which is helping us in maintaining these margins or improving these margins. And that is because of the machining mix and the product mix which is changing for us. And more critical components we are machining within the same product range because the crankshafts today that we machine for the PV sector as well as for the commercial vehicles as well as for the export sector are far more critical and superior in comparison to the farm equipment sector we used to do. And also the realization on those businesses are far superior. The criticality and tolerances are far more superior. So that we will continue as the learning curve. We will continue to go in for more and more critical components. And the idea is that we maintain a very healthy gross margin going forward as well. But at the same time, we will not restrict our growth on the as-sold businesses if we see that. So on the growth side, yes, as already mentioned, that industry has witnessed a sharp decline, especially on the CV side, whether it is domestic as well as globally. And on the off-highway segments globally, we have seen a major impact as well. We have seen the inventory correction happening on the CV side as well as on the farm side because the min-max levels for our inventories has corrected sharply, where we have almost seen in certain customer range 40% decline in quarter 2. So we expect that the market to continue and markets to come up to the flat levels where we get guidance of 15-18% type of a growth on a medium term is sustainable looking into the new projects which we are doing, looking into the new businesses we are going in. So on the PV side, the new segments that we have added on the PV side as well as the industrial side will keep on helping us besides the business and the new products we are developing on the CV side as well as on the off-highway side.
Okay, sir. Thank you for the detailed answer. So what would be the capex number for FY25 and FY26?
So as of now, it's to the tune of 200 to 250 crores per annum.
Okay, sir. Thank you.
Thank you. Our next question is from the line of Mihir Vora from Equirus Securities. Please go ahead.
Yeah, sir. Hello, am I audible?
Yes, Mr. Mihir.
Yes. Yeah. So thanks for the opportunity. So basically, I wanted to check whether the farm equipment segment saw a good growth in this quarter, which was outperforming the industry production growth. So was it led by our existing business or are we ramping up some new orders here? And was it domestic driven or are we also seeing some export traction in this segment?
So far our farm equipment business is in fact on the global level it is impacted because we are tier 2 in some of the businesses and on the farm side. But the farm sector growth is largely driven by the new businesses where we have kind of ramping up for one of the new players on the crankshaft side. And we continue to maintain this as there is a dedicated investment we have done in H1. So it's because of the new businesses and also because of some of the new product range that we have developed for our existing customers, which we were not catering earlier. So it's because of the product addition as well as because of the new introduction.
All right. So we can expect it to outperform in FY25, 26 as well, given the new customer addition. And
Yes, we have a very strong relationship, and we expect to, grow, with new products. Our endeavor is to grow with new products and with new clients. So definitely, and if we see that the market is coming back on track, that will definitely help us in a positive momentum.
Sure. And my second question is on looking at your numbers, the other expenses seem to be higher in this quarter. So is there any one-off there, or can you point out something?
Pankaj is just checking. Let's give us a minute.
It's somewhat on account of the logistics cost on the export side. One part is in there, where you can see the extraordinary cost has been increased in the different price. Yes. The main factor has been that one, and nothing other than that. Neither is it.
This is expected to continue, or will it, sort of cool off? In terms of sales, this is now 21% of sales. So will it, as such, you are seeing some cool down there going ahead?
So our other manufacturing expenses includes, as we do a lot of machining, so there is a lot of tool costs, lubricant costs, packaging costs, everything, including maintenance costs, part of the other manufacturing expenses. But the cost which has gone up for us is the logistic cost, largely on account of Red Sea crisis.
Okay.
Where some bit of it is kind of passed on by international OEMs, but there's some bit that we are still taking hit.
All right. So does this come with a lag or something like that? Like if you can get realizations on this and increase some realizations to cover it?
It is kind of passed on an average by around 60% by different OEMs, some by 50% and some by 75%. But we expect this to come down. So it is because of the geopolitical and global conditions. It still remains to be high. But if it cools down, then definitely we will have a positive impact.
Another cost will be on account of capacity utilization. There will be additional capacity utilization, but the minimum cost has been there. So since we have a 55 to 60% capacity utilization in terms of the forging, some you can say unavoidable maintenance costs would have also been there, which we think down the year when our capacity utilization will be optimum, this percentage will have some softness on that front also.
Sure. Okay, sir. So that's all from my side. Thank you.
Thank you. Our next question is from the line of Amarkant Gaur from Axis Capital. Please go ahead.
Hi. Good morning to everyone, and congratulations, Ashish and team, on a wonderful performance this quarter. I had two questions. One was related to the outlook on the farm side. One of your customers yesterday on its call talked about decent traction being seen in the farm industry and revised their outlook upwards. But at the same time, they talked about some higher inventory being there and some correction may be required. So how are you seeing the farm segment performing for you for the rest of the FY25?
So at the moment, we have just seen some positive revision from one of the OEMs on the domestic side. The growth that we have seen in the last month on the farm side, year on year, in terms of October numbers, could be, we have to see the November sales as well, because last year Diwali was in kind of 10th of November. So we also have to see the sales impact of November versus November to actually conclude if there is a meaningful growth. So yes, there is a positive revision by one of the OEMs, and if we see this revision, definitely we can have a positive impact of the domestic sales. But on the other hand, on the European and the North American side of off-highway business, most of the players we have seen quarter-on-quarter degrowth, and because of this there is some inventory restocking which is kind of going on, which we expect to clear up by December in most of the cases.
Understood. And my second question was on, pardon me if I got you correctly, you were getting into the ring forging business as well, right?
Yes. We are already doing.
So what kind of capacity addition would we have there, or would existing capacities be sufficient for that? And what is the outlook there? What kind of addressable market you're looking at? Any numbers, targets, anything you can indicate on that?
We are catering to the wind segment from our existing 14,000 ton press line, where we are able to forge components up to 250 kg, and also our 8,000 ton line, where we are doing full machine components. And this business will continue to grow for us within the industrial space. Currently, the wind business is almost 7% on the total business. We expect this business to grow by almost 20-25% going forward in the next 2 years because of the businesses that we have in hand.
Understood. Thanks very much, and all the best.
Thank you. Our next question is from line of Deep Shah from Yes Securities. Please go ahead.
Yeah, hi Amit. Thank you for the opportunity. So just a question on the gensets opportunity that you have just talked about. So there are few subsegments that you have mentioned. First is some portable gensets, and the second is higher weight gensets that you have talked about in the past as well. So overall, from 2 to 3 years perspective, how big this opportunity can be as far as the revenue share is concerned within the industrial? And second question related to that is there what's going to be a dedicated capex, especially for gensets as a business? So that's broadly what I wanted to understand.
Thank you, Deep. Deep, on the portable gensets as well as on the mid-category size gensets, the businesses that we have taken and the businesses that we are talking about will not need capex in terms of forgings. We have the forging capacity available, and the part range will be less than 90 kg that we can cater from our existing line. We will be needing investments only on the machining side. As the machining capacity utilization is high for us, there will be dedicated investments for that, and we will be ramping up. As far as the higher horsepower category is concerned, we will be needing certain investments, and we will be in detail discussing on it because we are still in discussion with our customers. So I think probably in a quarter or so we'll have more clarity over it.
Okay, but overall, in terms of the opportunity size, the revenue opportunity size, how big that can be, let's say, over the next 2 to 3 years perspective?
Deep, in the next 2 to 3 years, probably we will not be able to cover the entire range because it has a very broad range. We'll be able to cover only a small range of the entire segment. So probably we can expect more businesses on the higher horsepower to come from third year onwards.
Okay. And for that specific segment, we will have incremental investments towards capacities.
Yes.
That's the fair understanding. Okay.
Yes.
Okay.
But it is a fairly large space to actually work on.
Okay. So basically, what you are trying to indicate is this can be one of the segments within the industrial that can be be a large chunk, let's say down the line 5 to 6 years.
Yes.
This is the opportunity. Okay.
Yes.
Thanks. Okay. Thanks a lot for this from my end.
Thank you. Our next question is from line of Mitul Shah from DAM Capital. Please go ahead.
Sir, thank you for the opportunity and congratulations on a very strong performance, especially in such tough environment. Sir, I have one question on a mid to long term point of view, that which are the areas within non-auto space which can be meaningfully big in next 3 to 5 years, and the way other players like leader Bharat Forge and all has grown in last 5-10 years on the non-auto side, what are the fields where we are focusing more?
Thank you, Mitul. So, Mitul, as already mentioned, we have to expand the product range. So if you see, when we have expanded our product range from 100 kg to 250 kg, we were able to add businesses on the industrial side, and the industrial business now contributes meaningfully to the revenue. Going forward, we expect to increase this product range from 250 kg and going for from 250 kg to 1 ton. If we are able to increase the product weight range, then definitely there are several industries that we can cater, and especially on the large gensets, on the large industrial products, and also some of the railway gears is something that we can cater to. But that will potentially come from a perspective of 3 to 5 years. But on the next 2 to 3 years, probably the businesses that we are doing on in terms of highway and on the large axle programs and also on the wind programs, which we are able to cater from our existing lines, which are in a weight range of 200 to 250 kg, that will continue to do well for us as we are developing the entire range of these products, which will largely have components coming from the wind sector as well as from the large axle programs, which is on the material handling systems.
Yes, so anything on the sectors like aerospace, marine, locomotive, huge sized forging requirement is there?
So we have to first expand our base, but yes, on the machining side, we are in a nascent stage. We have started working on some inquiries and some discussions on the defense business as well. But it will take some, depends on aerospace, but on the machining side, as currently we cannot forge the type of size requirement which is there on terms of the requirement.
Yes, sir. As you highlighted, it's at very initial stage, but if you can help with slight more detail on the defense side, what are the products or what are the product portfolio where we are focusing over next 1 to 2 years, maybe in a small quantum, but which are the areas to look at?
So Mithil, we have just started working on the defense side, and probably next few quarters we'll have more clarity over it. But the product range which is under 200 kg can be done on the defense side, which are related to the tank product range or whether they are related to the machining of certain components. So that is something that can be done.
And that's directly with the government, or we are supplying to some tier 2 or tier 1 company?
That will come directly with the government tender, through government tender.
Okay, sir. Thanks and all the best.
Thank you.
Thank you. We'll take our last question for today from the line of Nihar Shah from Ikigai Asset Managers. Please go ahead.
Hello. Yeah, hi. All my questions have been answered.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Ashish Garg for closing comments.
With this, I would like to thank everyone for joining on the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with me or Strategic Growth Advisors, our investor relation advisors. Thank you so much for joining the call.
Thank you. On behalf of Happy Forgings Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines.